Welcome to This Explainer. Today, we're tracing the fascinating connective tissue of economic risk, moving all the way from the smartphone in your hand right up to the global stage. We often think of the economy in these isolated buckets, our personal savings over here, national policies over there, and global conflicts somewhere far, far away. But the reality? The reality is that risk cascades through a highly interconnected system. Here's a quick roadmap of what we're covering today. First, the retail finance trap. Second, Canada's national economic gambles. Third, navigating the tariff wars. And finally, global shocks and oil. All right, Section 1, the retail finance trap. Let's start down at the micro level. So, starting right at the micro level, we really have to ask ourselves, is investing basically turning into a casino? Because the gamification of finance is setting these incredibly alluring traps right now. We've all seen those viral TikTok trends, right? The ones promising absolutely impossible returns, with influencers telling followers they can turn a $2,000 tax return into $30,000 in 6 months just by blindly buying tech stocks. It sounds amazing, especially to anyone looking for a way out of living paycheck to paycheck. But it completely distorts the reality of market returns, setting expectations so high that people are pushed to take on reckless levels of risk just to chase them. And the messaging from these platforms brilliantly illustrates what we call the illusion of an edge. The pitch from traders promoting Polymarket, which is one of those currently booming prediction markets where you can literally bet on almost any future event, is that it's easy money. They claim you can beat the market just by trading off general news headlines, like the release of legal files. But think about it. If you're trading off the exact same public news headlines as millions of other people, you don't actually have an edge. You're just gambling on binary outcomes where a single wrong bet can wipe out your entire investment. So here is the harsh reality check. Despite all the massive hype you see online, the median return for retail users on these prediction markets is a dismal -8%. Yeah, negative. Which means the vast majority of regular people are just losing their money. Now, executives at platforms like Kalshi and Polymarket love to claim these tools are truth machines, generating the so-called wisdom of the crowds. But honestly, the data tells a totally different story. All that retail money pouring into these apps, it's largely getting captured by a tiny, tiny group of sophisticated professionals or insiders who actually possess an unfair technological or informational advantage. It's a negative-sum game for the average user, functioning way more like a casino than any kind of sound microeconomic foundation. Okay, let's move on to Section 2, Canada's national economic gambles. We're zooming out to the meso level. So looking at an entire country, Canada in this case, we see a proposed sovereign wealth fund dubbed the Canada Strong Fund. Now this gets compared to Norway's famous sovereign wealth fund a lot, but look at the stark contrast in the numbers. Norway's massive $2 trillion fund is driven entirely by excess budget surpluses from nationalized oil. Canada, on the other hand, is operating at a deficit. They'd be funding this $25 billion fund through debt. And unlike Norway, which diversifies globally, Canada plans to concentrate this borrowed money entirely on private domestic infrastructure. And concentrating a debt-funded wealth fund entirely into domestic infrastructure carries some severe execution risks. Take the Trans Mountain Pipeline as a perfect example. The Canadian government bought it to basically save the project. And sure, it got built, but the cost ballooned to roughly $34 billion. That is over 6 times its original estimate. Lengthy regulatory processes and political misalignment make these massive infrastructure bets highly vulnerable to costly delays, which is incredibly perilous when you're paying for it with borrowed money. Let's pivot to another massive regional gamble happening right within Canada's borders, Alberta separatism. Separatist groups are actually claiming that if Alberta leaves Canada, they're owed roughly half of the entire $334 billion Canada pension plan. Half. But economic analysts are quick to point out that this calculation completely operates in a vacuum. It entirely ignores the massive demographic flow of workers who move to Alberta to work in the oil sector when they're young and then retire to other provinces to collect their pensions later. The 50% claim simply doesn't reflect the real demographic mobility of the country's workforce. When you actually compare the promises of independence against real economic models, it reveals a pretty harsh reality. Sure, separatists project tens of billions in fiscal surplus and lower taxes, but their own data relies on essentially commandeering pensioner income just to balance the books. On top of that, creating a new border could immediately landlock their volatile, oil-dependent economy. Literally, just a 5% increase in trade costs from new borders could cost the province up to $20 billion annually. And that's alongside the massive startup costs of creating a new currency and military totally from scratch. All right, Section 3, navigating the tariff wars. We are now jumping up to the macro level.
Zooming out to the macro level, we can really see how the chaotic, totally unpredictable nature of global trade policy disrupts the economic baseline for absolutely everyone. Just look at how fast-moving this trade saga is in the US right now. The Supreme Court recently struck down tariffs implemented under the IEEPA law, a statute meant for international emergencies, ruling them illegal. But the ink was barely dry before the administration used emergency powers to instantly slap on a 10% replacement tariff, which was then swiftly bumped up to 15% over the weekend. These new tariffs are temporary, set to expire in 150 days without congressional approval, which injects a massive amount of uncertainty into global supply chains.
The fallout from this whiplash? It is staggering. The U.S. government has already collected roughly $175 billion from those original tariffs that are now considered illegal. $175 billion. And that money is already baked into the federal budget. Figuring out how, or honestly even if, to refund this massive sum to the importing companies that paid it is going to trigger years, if not decades, of highly complex litigation in the courts. So, the big takeaway here is the really profound legal precedent set by the major questions doctrine. The Supreme Court essentially ruled that the president has lost his favorite big stick. He can no longer just bypass Congress and bludgeon trade partners with massive, sweeping trade taxes on a whim by broadly citing national security. Any long-term structural tariffs are now going to face a much, much higher legal barrier, which fundamentally shifts how the U.S. approaches global trade. And you know what this volatility does? It forces other nations to radically hedge their bets. To avoid potential U.S. economic coercion, we just saw Canada sign a massive and, frankly, controversial trade deal with China. Canada agreed to allow up to 49,000 Chinese electric vehicles into the country at a sharply reduced 6.1% tariff. In exchange, China dropped its punishing 84% tariff on Canadian canola oil all the way down to 15%. With the USMCA trade agreement up for a very tense review in 2026, countries are actively reshaping global trade lanes right now to protect themselves from unpredictability. Finally, Section 4. Global shocks and oil. Let's talk geopolitical risk. Moving to our absolute highest scale of risk, we have to look at the Strait of Hormuz. When the U.S. and Israel recently struck Iran immediately threatened to close this specific passageway. It's a waterway that's just 33 kilometers wide at its narrowest point, but the data shows exactly why threats to close it are so terrifying. It handles 31% of the world's seaborne crude oil, a full fifth of the total global oil supply, and a third of the world's urea, which is a critical fertilizer. This is exactly why the mere threat of closure immediately spiked global oil prices by 30%. So what we're watching right now is this fascinating, real-time battle between immediate market panic and long-term infrastructure planning. The immediate shock is undeniably severe. We're talking hundreds of stranded ships, canceled marine insurance, and liquefied natural gas prices surging 60% overnight. But the global economy does have built-in mitigations. Countries like Saudi Arabia have spent years building massive backup pipelines with a 5 million barrel per day capacity out to the Red Sea, specifically to prevent the total loss of Middle Eastern oil in exactly this kind of worst-case scenario. But make no mistake, the stakes here are astronomical. Based on economic modeling for an extended, multi-year conflict, the cost to Iran's economy alone could be over $1 trillion in lost capital. $1 trillion, plus a 30% economic contraction. For the rest of the world, a prolonged shock to this region pretty much guarantees higher global inflation, skyrocketing freight costs, and central banks potentially being forced to hike interest rates just to keep prices under control. Okay, bringing it to the conclusion, let's tie it all together. All right, to tie this whole picture together, mitigating risk really requires looking past the hype and focusing on the underlying data at every single level. At the micro level, it means completely ignoring those TikTokers selling you illusions of easy money on prediction markets. At the meso level, it means critically scrutinizing politicians who promise a painless path to economic independence or guaranteed returns on debt-funded national projects. And at the macro level, it means preparing your expectations for chaotic trade policies and geopolitical shocks that are going to constantly test global supply chains. The global economy is this incredibly interconnected web of risk. Think about it. A missile strike abroad impacts energy prices, which in turn impacts global inflation, which then hits the very same tech stocks that retail investors are gambling on back at home. It's all connected. Leaving us with one final thought to ponder today. When the macro shocks inevitably hit, how protected is your micro portfolio? Thanks for joining me for this explainer. I hope it helps you navigate the noise.